Hello, and welcome to this week's edition of Checks and Balances TV. Today's program is entitled, The Dow Hits 13,000. What does that mean for our economy and your investments? So let's see how today's news may impact your financial future. The Dow Jones Industrial Average crossed 13,000 points on February 21st. The first time this has happened since May of 2008, shortly before the Great Recession took its toll on our economy. The U.S. stock market has climbed steadily this year, and reaching this 13,000 symbolic milestone has given investors new confidence and Americans renewed hope that the economy may be in fact finally on its way to a real recovery. Okay, so what's really going on here? Let's check the facts using our checks and balances process. The Dow Jones Industrial Average, a leading economic indicator, recently hit the 13,000 mark for the first time in nearly 4 years. The last time the Dow was at 13,000, the unemployment rate was 5.4%, the national debt was less than $10 trillion, and the soon-to-be financial crisis was nowhere in sight. Now with unemployment above 8%, although improving, and the national debt more than $15 trillion and growing, the Dow Jones 13,000-point milestone could motivate investors to pump more money back into the markets and grow the economy. Investors have already begun moving money out of safer investments, such as government bonds, to invest in stocks. When Americans invest in U.S. companies, the companies gain additional resources to expand and hire more workers. This lowers the unemployment rate and increases federal revenue, as more people are paying more taxes. Consumers, in turn, become more confident in their personal finances and in the economy, and they begin spending more money. This fuels the growth of the economy, gives investors more confidence, and round it goes. When analysts try to determine the future of our economy, they look at key economic indicators. These indicators can be leading economic indicators, meaning they change before the economy changes. Stock market returns are considered a leading indicator, as the markets usually begin to decline or rise before the rest of the economy reacts. Other indicators used to predict the future of our economy are those tracked by our U.S. government and published by Congress. These include things like the rate of unemployment and inflation, the state of our national debt, the country's gross domestic product, and consumer confidence and willingness to spend money. The combination of unemployment steadily declining and the GDP growing in every quarter of 2011, along with the stock market's recent performance, has made some analysts optimistic that the economy is finally moving in the right direction. Okay, so now that we've checked the facts, let's balance this news using our checks and balances process to determine what action you should take today. Just last fall, the Dow Jones was at 10,655 points. The 13,000 mark is a 22% increase from that recent low and only 9% away from its record high. However, there is no guarantee that we're on a straight path to recovery. The last time the Dow closed at 13,000 was on May 19, 2008. But by October 10th of that year, it closed at 8,451 points. And by the following March, the Dow closed at just 6,547 points. Anything can happen, which is why we shouldn't get too excited yet. Critics argue that the Dow Jones is an imperfect measure of the country's economy, since it's made up of just 30 companies. Dow Jones Company, which decides which 30 companies are the best barometer, says the index can accurately represent the economy, because the 30 stocks make up 25 to 30% of the market value of all U.S. public companies. Some, though, argue that the S&P 500, which is comprised of 500 of the country's largest public companies, is a broader barometer of the economy, and its performance is a greater reflection of investor confidence. As of recording time, the S&P 500 was up just a little more than 8% for the year. But if there is a black cloud on the horizon in what appears to be an otherwise promising economic future, it's the impact that rising energy costs will have on the pocketbooks of all Americans. While more Americans may be getting back to work, it's going to cost them more to get there. Gas prices are expected to hit an all-time high this summer, some predicting as much as $5 a gallon. A spike in gasoline prices early last year nearly put the U.S. economy back into another recession. U.S. gas prices have jumped nearly 9% already in 2012, setting a new record for this time of year when gas prices are usually lower due to the decrease in consumer demand. The highest price we've seen for a gallon of gasoline so far was $4.16 in July of 2008, right before the financial crisis began. Unfortunately, the rise in gasoline prices poses a real threat to both inflation and economic growth, two of the key economic indicators that help determine if the country is really on a path to recovery or if it's in fact a false start. Okay, so what's the bottom line here? All in all, the Dow hitting 13,000 points is a psychological milestone for investors and shows that overall confidence in our economy is rebounding. But we aren't out of the woods just yet. Investors did the same thing when we hit 10,000 points in the year 2000, and at every milestone since then. And the last time we hit 13,000 was a mere 5 months before American investors lost trillions of dollars as the stock market plummeted in 2008, forcing many to alter their plans for retirement. It seems as though many people have a very short memory. Be sure you learn the valuable lessons from the last recession and protect your nest egg from history repeating itself. If you haven't made any changes to your investment strategy, then the Dow Jones reaching 13,000 points only means that you're just now breaking even. And breaking even may feel good, but it also means you didn't make any money. A volatile stock market can be bearable as long as you learn from history and don't make the same mistakes twice. So work with a true financial advisor and protect your assets from the next big bear market. And now for Matt's weekly financial tip, tool, or technique. The worst part of the recent financial crisis is some of its negative effects which still linger today. And even if the economy is on the upswing, the recession's lessons should not be forgotten. So here are 3 important financial tips to protect and preserve your life savings in any economic environment. Tip number 1, protect a percentage of your money from risk and potential loss. Be sure a portion of your retirement investments are shielded from stock market risk. Although not an exact science, a general rule of thumb is the investment rule of 100. Simply put, take your age and subtract it from 100. The result is the percentage that you could have exposed in the market. And the remainder, which is your age, should be the percentage of money you have in safe and secure accounts. Tip number 2 is to diversify your investments into multiple baskets. Diversification is the key to not allowing any significant shift in the economy to put a halt to your financial future or retirement dreams. And there are numerous financial instruments and investment vehicles that are considered non-correlated, which means they are not directly tied to the performance of the stock market and do not decrease in value significantly when the market is in a tailspin. And tip number 3 is index your way to safety and growth. With today's extremely volatile stock market, look for ways to harness the wild upswings and downswings we've experienced over the years. With things like indexed CDs, indexed annuities, and indexed universal life insurance products, each of these types of accounts offers you the power to capture a part of the gain in a rising stock market, but incur none of the devastating effect or loss of principal in a down market. To protect and preserve your nest egg as you approach retirement, remember these 3 very important financial tips. Will Rogers had a very wise philosophy about his money as he aged. He said, "I am not so much interested in the return on my money as I am in the return of my money." Great advice to live by in these volatile times. Be sure to log on to our website and download our featured report, The Truth About Retirement, a free report that gives you the keys to preparing for and living a financially secure retirement. And finally, remember that only you can control your financial future. You can succeed. You just need confidence and determination. I'm Matthew J. Reddick from Checks and Balances TV. Until next week, dump debt, invest wisely, believe in yourself, and make it happen.